Hi all, so this is a video going through the Chapter 13 Wiley Plus assignment. It's a relatively long assignment, so this might take a couple of minutes. And my screen's really annoying this way, but so the first question is ARO. Some of the math is a little goofy, but the steps otherwise are very consistent with what we'd be expected to do. So we spent some money on a drilling platform, the 4695, or whatever your number is. So that would be your initial cost, is to create an asset for the drilling platform and the cash. And then the second one is to set up the ARO. And this is where the math is a little goofy. It says that the estimated cost is 817, or again, whatever your number is, 6-year life, and there's an interest rate down a little further. So you need to figure out the present value of this estimated cost. And then this is where the math gets a little goofy in that they say 70% of that cost is related to dismantling caused by the asset itself, and the remaining 30% is related to production. So after you calculate this present value, your ARO amount you're going to record and debit the drilling platform is 70% of the fair value, or the present value, sorry. So I actually made sure that was the right answer and tried it. So in my case, it was 360,000. So calculate the present value, take it times 70%, or if you have a different percentage in your question, and that's going to be your credit to ARO, and it will be a debit to the drilling platform. So that's the first part. Next is to record the journal entries at the end of the year, so the adjustments. So depreciation, right, is going to be your asset value divided by the useful life in years. The interest expense, again, whatever the balance in your ARO is, times your interest rate. And then the production of oil inventory, that's where we're going to increase the ARO for the amount related to production, and I believe they give us those amounts in the table. Yeah, the present value of the increase in the ARO related to production of oil was 27,802. So you're going to credit, try inventory. Yeah, we're using IFRS, and if that doesn't work, try cost of goods sold. 27,802. Let me try it. So the credit's going to be to asset retirement obligation. The debit, let's put to inventory and see if that works. And the amount was 27,802, I think. Yeah. And let's submit that and see how it works. I assume you all have this Wiley question stuff down pat. You have unlimited attempts, so yeah, I would submit answers regularly as you go through parts of the question. There we go. So we did good. Okay, so use your numbers, do the same thing. Prepare journal entries for the following year. So I think the only thing there, the interest is going to change because you've added to the ARO last year with both the interest accrual and with the production. Other than that, it should be the same, and you've got a different amount for your production. Now it's saying, assume that on December 31 we dismantle and remove the platform at a cost of $792, and assume the carrying amount at that time is $817,000. So what do you do at the end of the asset's life when you spend the money? You need to get rid of the asset, you need to get rid of your ARO, and any difference is a gain or a loss. So for sure, my credit is to cash for $792,290. The wording here is a little unclear, but I believe, yeah, settlement of the ARO. So we're getting rid of the ARO. And it's on my books for $817,000. And the difference, you guys can do math. I'm assuming we have a gain or a loss on asset retirement obligation. There we go. So this is going to be a debit, so it's going to be a loss. Okay, so we estimated it was going to cost us $817. It only cost us $792. Sorry, it's going to be a credit, so this will be a gain. And let's just check and see if that works out. It's pretty mean of me to give you such a long question. It's good practice, though. It's kind of repetitive of things we need to do. Yeah. So we did good there. Okay. We accrued $817. We only spent $792. So at the end of the asset's useful life, when we actually clean it up, we have a gain. ASPE, we're going to do the same things. Certainly the initial entry is the same. The depreciation in the first year will be the same. Again, don't use interest expense, use accretion expense, because somehow the textbook thinks a different word makes it different. And when you adjust the asset retirement obligation for the production, that's going to go to the platform. Let's try that. Okay, so I was happy with those amounts. So everything's the same as above except for those two account names. And then obviously when you get into the following year, your depreciation expense is going to be different because you have a different asset value. So whatever you have left divided by the number of years you have left is going to be your depreciation. Your accretion should be the same as above. And the asset retirement obligation, same as above. And this should be the same as above, right? Because we're still paying $792 and we still have something on our books for $817. So that should get you through that question. It'll take a bit, but again, it's good practice. It's all stuff that you might be responsible for in an exam. This one is a payroll question. This should go much quicker. Very similar to what we did in class. We've withheld not only taxes here, we've got union dues. So same thing, we're going to set up a union dues payable when we process the payroll. We also have to calculate the amounts for EI and CPP because they've just given us percentages. So payroll's $400,000. Oh, insurable earnings $300,000. Again, terminology you really didn't need to know for this course. Use the $300,000 to do the calculation. So 300 in my example, 300,000 times 1.66% is the employee EI amount. 300,000 times 2.324% is the employer, the company's portion of EI, etc., etc. So we're going to record payroll expense and we're going to record the payables and the expenses for CPP, EI, and the income taxes and the unions. Okay, and similar to the example we did in class, we'll do the employee portion first, then we'll do the employer portion. and then we'll pay it to the receiver general. So if you go back to the example we did in class, the entries should be the same, except you got the union dues added, and the math will be a little different. And this one seems to give students grief. For every dollar of salaries and wages that Avaya commits to pay, what is the actual cost of the company? So all you want to do here is add up all your expenses. So payroll expense, CPP expense, EI expense, and divide it by the payroll expense of $400,000. And that's going to get you a number that's, probably 1.05 or 1.06. I'm not sure. That's basically saying every time you pay an employee $1, it costs you $1.05. It costs you $1.05 because you have to pay EI and CPP. Okay, so this number should be 1 point something. That should get you through that, hopefully. And good luck. Any questions or any grief, give me a call. Don't waste a bunch of time on it if you're not following what Wiley wants. Send me a message. I'll get back to you as quick as I can and make it easy.